Welcome back to our 10 episode series on building a strong and diversified portfolio using passive instruments. In the previous 4 episodes, we have covered the basics of passive investing, reasons to invest in passive funds, how to decode a fund offer document, and why Nifty 500 is a good starting point to begin your investing journey. If you haven't watched them yet, we strongly recommend you to do so. Today's episode is about investing in debt and commodities. But before we dive into that, let's discuss if investing in Nifty 500 only is enough.
So, I think, should you invest in only one equity mutual fund? I think the answer for 99% of the people is no.
Okay.
I think you can. I think it's definitely makes life very simple. But I think in terms of recommendation, I think it's not advisable for any investor to invest 100% of their capital into one mutual fund that is Nifty 500, because obviously 100% equity portfolio may not be suitable for most people.
Okay.
It comes with a lot of volatility. So I do believe that, and also I think the economy, because of volatility, goes through a lot of good and bad cycles.
Yeah.
So we believe that the best way to invest in into your portfolio is to have multiple asset classes.
Okay.
You should have a combination of equity, a combination of debt, commodities and fixed income, and also international equity.
Yeah.
I think the best portfolios are the ones that are diversified across stocks through mutual funds.
Okay.
And also diversified across asset classes.
Okay.
And the beauty about passive funds is that you can find just like you found a easy passive equity fund like a Nifty 500. Passive funds also provide you simple funds across different asset classes. So you can buy a passive debt fund.
Yeah.
You can buy a passive commodity fund. You can buy a passive international fund.
Yes.
So I think the beauty about index funds, ETFs, is that you're able to provide, you're able to find building blocks for your portfolio across different asset classes.
Yeah.
And we believe that is one of the best ways of investing or building a portfolio.
Okay. So considering there's so many asset classes that you mentioned right now, considering we've also said Nifty 500 to be the starting point for investors. So what after that? Like if step 1 is Nifty 500, then what is step 2 according to you?
Yeah, so step 1 or step 0, would be to find your allocation.
Okay.
So how much of your money should you allocate towards equity versus debt? And I think a multi-asset solution is the best for most investors.
Okay.
So I would say step 1 is obviously your risk profile, as we said. What's your allocation? And maybe a part of your equity allocation can do Nifty 500.
Okay.
We believe the reason why you should have a multi-asset portfolio, and this is the underlying reason, is because it really takes out market risk from your portfolio.
Okay.
So suppose what we've seen is that different asset classes move in different cycles.
Yeah.
So today, today equity is doing very well.
Yeah.
Tomorrow maybe fixed income does well.
Will do better.
Third year gold will do well. Fourth year international will do well.
Yeah.
But so by having 4 different asset classes in your portfolio, you're basically taking out market risk from your portfolio and you're making your portfolio a lot more stable.
Yeah.
So tomorrow if equity does badly, because you are exposed to other asset classes, your overall performance of your portfolio will not go down as much.
Okay.
So I think that is the beauty about having multiple asset classes in a portfolio,
Yeah.
which is why something like commodities, gold and silver, something like fixed income,
Yeah.
like international, can be an excellent source of
Okay.
diversification. So there's 2 forms of diversification. One is stock level diversification,
Yeah.
which you anyway gain in an index fund, Nifty
Yeah.
500. The second one is asset class
Yes.
diversification, and so I think both will really make your portfolio a lot more stable.
Okay.
And this happens if you add fixed income or commodities to your portfolio.
Okay. So can we consider debt, because you mentioned so many asset classes? Let's begin with debt as an asset class. What are your thoughts about it? Do you think after investing in something like Nifty 500, I could perhaps start looking at debt instruments directly, or does it come way later?
No, I think debt is important. Debt acts as a natural hedge.
Okay.
When your equity market, when your equity portfolio is not doing well.
Okay.
So I think having fixed income in your portfolio is very important.
Yeah.
When you're choosing debt investments, from a passive standpoint, there are 2 different types of debt funds that you could buy.
Okay.
One is called a target maturity fund, and
Yeah.
the other one is, say, a normal debt fund.
Okay.
And the main difference between these 2 categories is that in a target maturity fund, you basically can lock in your returns
Okay.
today, and you can. So, for example, there's a target maturity fund that matures in 2030, and your current yield is about say 7%.
Yeah.
So it's like almost like buying an FD, but in a mutual fund space.
Okay.
Whereas in a non-target maturity or a normal debt fund,
Yeah.
you're basically relying. It's a perpetual debt fund.
Okay.
So basically, you don't have to worry about the fund expiring.
Hmm.
You're basically investing in a very low risk, sort of perpetual debt portfolio,
Okay.
which will give you that 5 to 7, 5 to 8% returns over time.
Okay.
So we believe that building a portfolio, if you're say investing for a goal in mind,
Yeah.
then you should probably look for target maturity.
Okay.
But if you're building a portfolio, I think a normal debt fund
Like
works
if you
very
have
well.
a fixed date saying that in 5 years I'm going to do this, and you
Exactly.
definitely need that money,
Yeah.
then you can put something like that.
Exactly.
But the way you've answered it also made me realize that they're very different from equity funds, right?
Yeah.
So would you like to elaborate a little bit about how debt funds work actually?
Yeah.
Because I think the fact that they can give you fixed returns means that there's something not similar to equity funds, right?
Yeah, so debt funds may you're buying, it's basically you're buying fixed income instruments. So the idea behind debt funds is that your sources of income is going to come from coupon payments.
Okay.
So if you're buying a government security, you're putting in principal amount of say 1 crore, and every year you will get 5%, say 5 lakhs from that. So that income is very streamlined.
Yes.
But it's very important for investors to understand that not all debt funds are equal.
Okay.
You have to also look at duration, which is a complicated product sort of concept, but it's very important for investors to understand that debt funds are not free of risk.
Okay.
Just because they're debt fund doesn't mean they're risk free.
Okay.
They have something called interest rate risk.
Achha.
What that means is that if you're buying a debt fund which has a very high duration, so if you're buying say companies or debt papers that are maturing in 10, 15, 20 years, then they have a lot of sensitivity to interest rates.
Okay.
So I think investors who are looking at debt funds should ideally stick with a very simple debt fund. So at Motilal Oswal, we have something called a 5-year GSEC.
Okay.
Which is a very simple debt fund that investors can invest in. They don't have to worry about interest rate risk or lower returns. It's a very sort of sweet spot.
Okay.
But also investors should so basically understand what is the risk profile in debt also.
Okay.
It's not just free. And in debt funds, obviously passive funds offer a lot of simplicity.
Yes. I can look at the entire process of building a portfolio is the base or the foundation has to be something that you secure very well, so that you know that there's not too much risk, and then you can take risk on top of it. The first step was looking into something like Nifty 500. And then when you have fixed income instruments like these ensure that long-term journey of your portfolio is safe.
Exactly.
Would you like to elaborate?
Yeah, so the whole idea behind debt funds actually is to really lower the volatility of our equity portfolio. Okay. I would say in my definition, because what we've seen is that there are certain years when equity funds perform badly.
Yeah.
And then that's when your debt fund shine. So I think the usefulness of a debt fund is to really manage risk in your portfolio. If you are a conservative investor, then you can lower your equity component, but the balance can go in debt.
Makes
Whereas
sense.
if an aggressive investor, most of your capital can be invested in equity, and the balance can be in debt.
Okay.
So I think it can be a great way of risk management in your sort of overall portfolio.
Okay. Does commodity work the similar way? Because a lot of people also say that commodities also act as an hedge to equity. How do they stand? Like, how different is commodity then?
Yeah, so I definitely think that commodities are also excellent asset classes to have in your portfolio.
Yeah.
I think something like a gold and silver. Again, as I said, when equity markets do badly, debt is there, and then you have other asset classes like commodities, which also moves in different cycles. For example, gold.
Yeah.
Gold. What we've seen historically is that gold tends to do really well when markets are bad.
Yeah.
So I think it could be a natural hedge towards towards like withstanding poor market conditions.
Okay.
So I think just like debt, commodities can also be one such asset class that can give you good returns when equity markets don't well. Also, commodities tend to be at least in a country like India, it tends to have very emotional value like gold and silver. So I think the acceptability of people buying gold and silver goes up dramatically via gold and silver, and you can buy gold and silver via simple ETFs or index funds. So I think commodity funds again offer you diversification. of you, and what we've seen over the last 15-20 years is that even the return profile of commodity funds have done well.
Okay.
So I think not only has it sort of delivered good returns, it's also helped investors from I think getting some sort of downside protection.
Okay.
So I think overall we sort of advise investors to have a multi-asset portfolio,
Okay.
which is a combination of equity, debt, commodities.
So Pratik, could you define commodity products for us very specifically?
No, absolutely. So I think equity, as I said, invest into companies. You're owning assets. Fixed income, where you're owning loans.
Yeah.
In commodities, you're basically investing into physical assets.
Okay.
Physical assets such as gold, oil, agriculture products. So I think these are generally used as a hedge towards inflation.
Okay.
So what we've seen is that commodities tend to do really well in terms of giving people outperformance over inflation. So that's why a lot of people like buying gold and silver and commodities. So we believe that commodities are physical assets, and the price of these physical assets are driven by demand and supply.
Definitely.
Demand and so for example, if I think for example this week I think the demand, the supply of tomatoes, for example, in India have gone down dramatically because of the rains in the north. The demand for say tomatoes have gone up to from 2 rupees to 100 rupees a kg, and that's basically investing into a commodity. Same way, if the price say post the Russia-Ukraine crisis, you saw that the demand for oil went up because Europe wanted to reduce its dependence on Russia. So I think the price of oil went up. So I think a lot of commodities, the prices move as with demand and supply, and I think that is what is what you're buying into when you're buying commodities.
Okay.
And I think commodity funds give you a combination of these commodities in a fund, or you can buy them individually. I think in India, I think for most investors, what you could buy is gold and silver are the two commodities that are listed. And I think these are also excellent instruments for someone who wants to build up a saving habit, or someone who wants to buy a digital version of these commodities.
Okay. Are they also the most common instrument, gold and silver, when it comes to commodity investing?
I think globally also, yes, they're the most liquid, most common, biggest markets. So I think especially in India, where I think India is one of the biggest markets for gold and silver. So I do think that they are good ways of diversifying a portfolio even more. Than just having equity and debt in a portfolio.
Okay. There's this stupid question I always had, and I wanted to ask this to somebody like you. Is it because commodities are limited in nature, they're bound to increase in price over a period of time? Would I be right to say something like this?
I do think that scarcity, there's a combination of scarcity and demand supply.
Okay.
So I think one is, yes, something like gold or something like diamonds, what really drives prices is scarcity premium. Where people know that there is a limited supply, and that's what's increasing in price. But it also has to do with overall production. So I think there is abundance of silver in the world, but maybe the silver mining is not optimized. There could be unlimited tomatoes in the world, but there might be a short-term crisis that doesn't allow. So I do believe that it's a combination of demand and supply, and also scarcity, which drives the prices of commodities. So something like a palladium, I think is a lot more rare. Which is why the prices of it goes up a lot higher. So I think it's a combination. So people should not look at yes, people can look at tactical bets in commodities, but I would say as an allocation, it's a good way of diversifying.
Okay. One of the tactical bets is also for a commodity like silver. They have a lot of applications in technology today. So considering scarcity and the amount of usage that it drives, is also like one of the major parameters. Like I've seen a lot of my friends getting into silver more than gold now, because they're looking at it is used in mobile phones now, and a lot of applications.
So silver is an excellent conductor. I think of electricity. So I think has a lot of industrial applications. It's used in semiconductors, chips. I think it has very industrial uses. So unlike gold, which is the uses are quite limited. Silver has a lot of industrial applications. So I would say that yes, the demand of silver will probably go up over time, which will lead to obviously I think higher prices. But also, I think silver is heavily linked to the economy.
Okay.
So what we've seen is that silver prices tend to do badly in bad markets
Okay.
and do very well in good markets.
Okay.
So I think
High
I would say,
correlation,
yeah, it's a high volatility investment. So as a part of your portfolio, maybe a combination of gold and silver makes sense.
Okay.
But I would say for an investor, they don't have to own commodities in their portfolio.
Okay.
But I think from a way of diversifying your equity exposure, so fixed income can diversify, but fixed income you're sacrificing returns for lower
Okay.
risk. In commodities, you're actually not sacrificing returns as much,
Yeah.
but you are getting an overall lower risky portfolio.
Okay, okay. Thank you very much for that clarity, because people often confuse between gold and silver. I got confused a lot too,
Yeah.
because within that there are asset allocations that you have to do,
Yeah.
and then you can't make sense of the proportion. But this actually gives us a lot of insight. And as you already know that we are also allowing individuals who are watching our video today to go through this journey ourselves, with us, along with us rather. So every episode, has a task. And what would be the task for such an episode where we're discussing commodities and debt together for viewers?
Yeah, absolutely. So, I think for the viewers, you can check the performance of debt funds as well as commodity funds like gold and silver across various market events. So you can talk about, when they performed well and when they didn't, and compare it with equity products, and find points where these instruments were the perfect buying opportunities and mention it in our comment section.
That sounds fair. Then they can see the correlation, how hedging actually works.
Yeah, it's a fun exercise to see how diversification sort of plays in when you're adding fixed income and commodities.
Sometimes you say the one side goes down, the other side has to balance it.
Exactly.
Maybe they'd be in a better position to view this. So thank you very much, Pratik, for taking such a complicated topic and delivering it under one episode. I would want to remind all our viewers that we've only touched the surface, and there's a lot for us to discover along all the other passive instruments that we have. So please watch our entire series. It's a 10 episode series, all under 10 minutes. Share this video with your friends so that they learn along with you. And do not forget to complete the task. It is meant so that you actually exercise what we're preaching right now. Thank you very much for being a part of this. Be sure to be a part of the next episode. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.